Hey everyone, this is Robert Keens with goldsilverpros.com. It is Tuesday, January 19th, 2021, and we're going to begin turning our attention to what we think is going to happen in the markets in 2021. That'll be the focus of this video. I'm going to extend this out to a very special presentation I'm going to be doing on January 28th. I've got an invite for you to come see that for free. I think you guys won't want to miss it, so stay tuned to the end of the video for that announcement. I'm going to go ahead and start the screen share, and we're going to start off talking about the gold market. I've been talking since early this summer about the gold market hitting a high of over $2,000 and then potentially forming a handle pattern. For those of you who haven't been following me, a handle pattern, when it comes after a cup is defined as basically a move just like this. When the handle pattern starts to form after the cup, it is an extremely bullish, like multi-year bullish indicator for a market, because a market decreases, it comes back and increases. It's a little overheated. It comes back and forms a handle, and then the momentum keeps going. That's extremely bullish. I don't know if we're going to finalize the handle pattern and come down to 1,700 gold, but if we do, it's extremely bullish for gold. What that also means, however, is a short-term gold price could come down. I'm not sure if that's going to happen. We're going to look at the chart, but it is definitely a possibility. Although I do see some bullish factors for gold going forward here in the next few months. Let's drop down to a shorter-term chart. The last time I covered the technical charts for you guys is a little while back. We talked about this range pattern. We talked about this downward sloping range pattern, sort of this disinterested gold pattern, which acts as a consolidation for people taking profits in gold and then people wanting to accumulate more. Of course, we had a breakout here starting in the beginning of December, and it broke out and formed a new channel. So we're in a bullish channel for gold. However, gold has come back down through its 50-day moving average and stayed below the 200-day moving average, though it's retried it a couple of times. So gold is still in a short-term bearish pattern, even though I think long-term it could be bullish. So I'm not sure if we're going to complete that cup and handle pattern, but if we do, I wouldn't be surprised, but that's okay. It just means that the move in gold is going to come probably a few months later than we expected it to, and it could ramp up at the end of spring, leading into early summer from a technical perspective. From a fundamental perspective, we'll talk about that in a moment as to why I think gold is about to resume its bull market. Silver, on the other hand, is a little bit different. No cup and handle pattern here, although we did hit highs over the last, since basically I want to say 2013 in the silver price, where it hit almost 30 bucks. It came right, and this is a near vertical move that happened in July. I called it about July 14th. I did a video that said we're about to have a big move in silver, and boy, did we. It just kept going up. But it's come back down, basically range trade, although silver never really got quite as bearish as gold did. It never came all the way down through its 200-day moving average. We'll see that on the short-term chart. It did have sort of this sideways consolidation trend, although it wasn't sharply down like gold was. Gold was down. Gold was clearly in a correction trend. Silver was really just in a holding pattern, and it never came down through its 200-day moving average, this red line you see here. So I've been a little bit more bullish on silver than I have been gold for that reason. Of course, silver came back through its 50-day moving average, as represented by this blue line. It's formed a new bullish trend, just like gold has, but it's a stronger trend because it stayed above its 50-day moving average. Whereas we go back to the gold chart, it's trying to get above its 200-day. So we'd like to see gold come through its 200-day and then its 50-day, but silver has stayed above. So silver's got a little bit more bullish momentum. And so when you look at the commitment of traders report on the COMEX, the futures market, you see more interesting things in the gold market than you do silver. Silver is basically kind of a war back and forth. Gold has been a consolidation pattern, and there have been some big movements in the commitment traders on the COMEX, which we're going to look at next. I didn't show this last week, but the exchange report, or the COT report on the exchanges as printed by the CFTC through January 5th had very bearish gold data. This report we're showing, the most recent report through January 12th. Remember, the CFTC reports on commitment traders are about a week behind the trading action, a week to 10 days. This goes through only January 12th. Now we're at the 19th. So it's a week old. And so in a few days, we should expect to get a new COT report. So this is all backward looking data. But to recap, the end of December and the first week of January, there was a lot of increased short positions by the bullion banks on gold to the tune of about 18,000 contracts. In fact, through January 25th, that particular week's COT data, it was 13,000 in some contracts, additional short side from the bullion banks. Well, that trend has reversed. We're going to see by going down to gold on this January 12th data. So here is the gold data. And if you go across to the overall changes, you see that the swap dealers or the bullion banks have released or gotten rid of almost 23,000 contracts of gold to the short side and have gone long another 900. So net about 24,000 contract change in 1 week's worth of data from the 5th to the 12th of January means that the swap dealers are trying to dump some shorts. Why are they doing that? We'll show here in a minute. On the opposite side of that trade, the managed money, the financial guys, basically dumped 36,000 of their longs. They basically capitulated to gold and said, you know what, we're dumping 36,000 of our longs because we don't see a strong move in gold to the upside because it just been range trading with a very small breakout here. That's why that had happened. So the managed money capitulated, the swap dealers took the other side of the position. Well, why didn't gold rise all that much? Well, because net, the open interest actually fell by 13,000 contracts. And net, there wasn't a big move up or down overall among the gold complex. So we did have it move up and down a little bit here and there. It recovered about 1900 there briefly and come back down. So there's been some volatility, but overall, not too much going on. That's because people are moving to a new contract month. So we're going to show you that here on the data. Previously, February was the predominant contract month. It had over 400,000 contracts. Now it's at 234,000 open interest contracts. The April month has jumped up to 229,000. So within the next few days, I expect to see April to become the dominant contract month in gold. What does that mean? For those of you not following me, when you look at the volume of the futures trades, we're talking futures contracts. They're taking a bet on the gold price in the future. So as time goes on, you have to constantly move that flow to a future contract month. And so that's what they're doing. They're moving off of February and into April. That's why we've seen all that movement on the Commitment of Traders report as people began to position for April. Now, we had a big spike in volume on January 8th, which caused the gold price to fall. And we've had some healthy volume here since then, but overall, the gold price has fallen. Now, if we look back a couple of days, like on the Wednesday data, and we go to the settlements, you can see that the gold price is being bid up into, well, let's get back to Wednesday. You see the gold price is being bid up into 1850 on the February contract. But if you look lately at Tuesday's data or today's data, you see them being bid down to 1840. So net, as they move the contracts from the February to the April contract, the price of gold has come down a little bit. People are taking bets on a little bit lower gold price. Now, that's just the futures trade. So if you just look at the futures price, you think, gold's not very strong, not a big deal. But if we look at the physical trade, we see something completely different. And that's what's bullish for the gold market going into 2021. One of the factors, I'm going to give you another one. Here on Nick Laird's site, Gold Charts R Us. I love this site. It's a pay site. Well, there's some free data there, but if you get into all of the data I get into, it's a pay site. It's well worth it. I'm not affiliated with him, so I don't get anything for recommending it. But if you want to see the gold changes over time, you have to get off the CME Group website. They charge you a lot more to see this data on the CME Group website. Basically, you have to be a big trader to be able to afford their information service. The free data only goes back 5 days, as you can see here, and in some cases only 1 day if we're talking about the actual depositories. So if you want to see things over time, you got to come here, and this is the best site for it. In any case, what's bullish, Rob? You just said something's bullish with gold. Well, here it is. Nick Laird is on this table is tracking all the physical gold movement on the depositories, the ETFs, the funds, e-funds, everything. And he's tracking where the physical gold is actually moving to support the gold trade. Now we noticed that net on COMEX, there's a change of 715,831 ounces to the upside over the last 4 weeks. 715,000 upside 4 weeks. More gold going into the COMEX vaults. What about all the ETFs and the funds and COMEX all added together? It gets even bigger. Over the last month, an additional 1.75 million ounces. That means people are taking delivery of more physical gold over the last month. More physical gold last month. So as gold price was falling over the last month, guess what? People take delivery. Makes total sense. Price goes down, people take more delivery. Now, something very interesting. Remember the last video when I talked about the basic collusion of the LBMA and the COMEX market? I called it the LBMA COMEX Ponzi scheme. What was happening was less delivery on futures contracts on the COMEX, more delivery through exchange for physical on the London market. What is exchange for physical? You take a futures position on COMEX, you go to London to the physical market and you take delivery. Not delivery on the COMEX market, but in London. There is a rumor out there by some popular gold analysts saying that the COMEX has threatened, or CME Group has threatened traders who take physical delivery on the stateside market, the COMEX market, the futures market. I cannot confirm that. I do not have a source for that. I do not have a URL for you or anybody telling me that. That's a rumor. However, whether or not that rumor is true, it seems to coincide with the data on the COMEX as to who's taking delivery and where they're not getting off the COMEX. Why? Because the registered category right here, there's two main categories, there's three categories on the COMEX, but two main ones, registered and eligible. Registered is the futures exchange where you have a warrant to the metal and it gets exchanged from one party to another when they stand for delivery on the COMEX. Eligible is not, it's glorified storage. So the eligible category has gone up by 859,000 ounces. That means people are happy to use the COMEX approved depositories for regular private storage that has nothing to do with the futures market, but they're less content to put it for futures delivery to the tune of down 143,000 ounces. So net, the gold has been going into long-term storage, not for exchange on a futures contract over the last month to a tune of 143,000 ounces out of registered and a net of 859,000 eligible and a net of 715,000 COMEX. So COMEX is becoming a storage only gold market, not a physical delivery market. And that physical delivery demand is going over through exchange for physical into the London market. And I showed you the last video how it was to the tune of 14 times the amount of delivery on the COMEX. And here we go again, another big print, exchange for physical on the February contract, 4,218 contracts worth of gold going from the COMEX to the London market. And in April, because we know that's becoming the dominant contract month, 640 contracts. People are taking delivery through London, not the COMEX. And we see it clearly here in this data as well in the 4-week trend. What that means is people are trying to get physical. They're not sourcing off the COMEX. So do we believe that COMEX available free gold for futures is really that robust? I don't know. They're not doing it right now. The last 4 weeks on the COMEX, they're switching over to the London market. That is an interesting development in the data. Now we're going to go on to talk about bonds. What does bonds have to do with gold? Well, bond rates have been falling over the last year. We're going to explain that. So over the last year, almost universally, with the exception of Brazil on this chart and Switzerland, on this chart from Bloomberg, we've seen falling one-year bond rates on the 10-year. Sort of the benchmark 10-year has been falling over the last year. Why has it been falling over the last year? Well, the economy's been deflating. Okay, money printing has ramped up this year, but the economy has been deflating. And so that's caused bond yields to fall. Why? Because of the shutdowns. However, it's started to ramp back up. Over the last month, almost universally, with the exception of Portugal, 10-year bond rates are up. Look at this 1 month column. Up 33 basis points in Brazil, 14 in the United States. The United States benchmark 10-year rate is now over 1%, which has caused a lot of hullabaloo in the financial press. Oh no, we're over 1%, which is really in the grand scheme of things over time, doesn't mean anything. However, the trend over 1% is fairly significant in the US because bond rates have been so low for so long. And across the rest of the world, again, with the exception of Portugal, bond rates have been up. Now, we're not in a massive bond rate bull market, but the fact they've been moving up over the last month is a big signal about what's coming to the economy. What is coming to the economy? Well, we go now to a Reuters article from the Fed. Fed sees rising bond yields, inflation expectations as a possible win. Now, we have talked about in the last few months on my channel how the Fed has wanted to get interest rates up. They've wanted inflation rates up in particular. And here's a statement from readers. The first paragraph will basically describe their strategy. A recent rise in U.S. bond yields and market inflation expectations have bolstered Federal Reserve officials' hopes that the central bank's new monetary policy approach that I've been talking about the last few months is taking hold and could be further buoyed if the Democratic-led Congress rolls out more spending. We're going to see where that spending is coming, and that's going to be bullish for gold in the long term. Why I think we're going to have a breakout overall in the gold pattern is because the expectation of higher rates. Anyway, in this article, they go on to talk about Richmond Federal President Thomas Barkin saying, I'm encouraged to see the rise in market indicator of inflation expectations, reflation trade. So they're starting to reflate the economy. So after the shutdowns, they're trying to reflate the economy. They're trying to jumpstart inflation. This is what's coming. And this is what St. Louis Fed President James Bullard says. The ingredients for higher inflation are in place. You have very powerful fiscal policy in place and perhaps more to come. In other words, fiscal policy is where they're engineering the inflation. As well as with Democrats now to control the White House and the U.S. Senate and House of Representatives, they have full control. They're going to spend, spend, spend. So now we go to an article in the New York Times. Biden outlines 1.9 trillion spending package to combat the virus and the downturn. So they're going to spend. They've been saying that they're going to spend. And there's going to be a change in taxes. They're going to extend higher tax rates, as you can see here in this article, to many families. So they're going to give some tax incentives to regular everyday families. They're going to increase taxes on corporations and the rich, according to this article. Mr. Biden plans to unveil another larger set of spending proposals in February, and he began laying the groundwork to finance those efforts by raising taxes on corporations and the rich. He drew a sharp contrast between the suffering of low-wage workers and those struggling without a paycheck, with the wealthiest Americans saying there's a growing divide among the few people at the very top are doing quite well in the rest of America. Now, he is true. He is correct about that, but this is more socialist policy coming. And I don't mean that in a derogatory term. I just mean it in the descriptive sense. When you're redistributing wealth, that is socialism. So going forward, more socialist policy, rising rates. Get the picture. More taxes coming, rising rates. What happens to the corporates when they pay more tax? As their tax rates rise, what happens to wage rates and hiring? They both stagnate. So expect more stagnation from corporate jobs and corporate incomes starting in 2021. At the same time, the Fed is pushing inflation. You get the picture. Your dollar is going to be weak. E.B. Tucker said that on my channel last week. He expects there to be a weak dollar policy. I agree with him. That means your dollar will buy less. And it also means your wages and your job prospects are going to stagnate, meaning more trouble for the middle class. As translated, that's what that means. And not to be outdone, in today's news on CNBC, Treasury nominee Yellen says U.S. can afford higher corporate tax rate if it coordinates with other countries. In other words, hey, if we raise corporate tax rates across the world's economies, it won't be so bad in the U.S. The U.S. will be under the shadow of the world, and we won't get blamed for these higher tax rates, is essentially what she's saying. She says, we look forward actively to working with other countries through the Organization of Economic Cooperation and Development, OECD, negotiate on taxes on multinational corporations to try to stop what has been destructive global race to the bottom of corporate taxation, she said in response to a question from Senator Mike Crapo. Now, she's going to be the Secretary of Treasury. She's the nominee. She's going to run the Treasury, okay, of the United States. They're going to raise taxes, more spending, higher inflation rates, higher bond rates. That's going to continue to destroy the middle class. It's going to stagnate some of the corporates in America and across the world, which could lead to a fall in the overall stock market. Rise in bond rates, fall in stock market, weaker dollar, weaker purchasing power. That's what's coming. That's why I think it's bullish for gold and bullish for silver. And I think if you want to invest in the precious metals, now will be the time to do so. Why before the prices have hit their big breakout. And I think we're probably going to see a breakout sometime in 2021. As to when, we'll have to see the trades. Now, on to the very special announcement that I have. Guys, I have set up our second virtual conference. This is going to happen on January 28th. As you can see here at the top, the times from 11 a.m. to 9 p.m. Central Standard Time. If you're on the West Coast, that'll be 9 a.m. to 7 p.m. On the East Coast, that'll be noon to 10 p.m. your time. And we have just announced this. We are going to have a lot of speakers at this conference. You can get to it by going to hopin.com. That is the platform we'll be hosting it on, /events/solutions 2021. And you can register for free, where we will talk about what I've been talking about on my channel and more. So some of the sessions we're going to have: surviving a currency crisis with Fernando Aguirre, who survived the Argentinian currency crisis. He's going to give his perspective on what could happen if we have a dollar crisis. We're going to get an historical perspective on America's economic troubles from a person who has, Dr. Scott Craig, who has a doctorate in the field of history. We're going to be talking about silver demand with Miles Franklin. We're going to be talking about gold and silver with James Anderson of Vesti Bullion. We're going to bring back Dezo, Karian Van Hest, to the program to talk about Bitcoin. I'm going to be furthering my conversation on the gold Ponzi unraveling the LBMA COMEX scheme. We're going to be sorting the noise to find good information. That'll be with one Alex Newman. We're going to be talking with the technical traders about managing financial risk. We're going to be talking about with Jerry Huang, principal of Gemini Capital, about mining stocks. If you're in the mining stocks, that would be a great session for you to attend. And we're going to bring in a conversation on preparedness. Daisy Luther from the Organic Prepper, a site in which I love very much, is going to be talking about preparing for harder times that we may see going forward as we see the global financial system start to hit the end of its current life cycle and move into the future life cycle. All these guys will be at the conference. Again, you can go to hoppin.com/events/solutions-2021. Sign up for free. It is free for attendees, guys. Hope you will join. I'll leave the link down in the description as well. Hope to see you there. I think it's be a lot of fun. Actually, the last 2 hours of conference, we're going to be doing an after party. You guys can come in with myself and some of the other presenters and just have a conversation for a couple hours, ask questions. If you got mining stock questions, gold questions, economic questions, preparedness questions, currency crisis questions, we're going to talk about all of that during the conference. So love to see you guys there. Please join us at the conference. And I will be unveiling as well, for the first time in the conference, my overarching thoughts on what the new global monetary regime is going to be and why they're putting it into place. I've talked about elements of it from the cryptocurrencies, gold and silver, the fiat dollars, so on and so forth on the channel, but I haven't sort of circled all the dots together and put it into one cohesive argument. I'll be starting that conversation here at the conference, January 28th. Please join it. You guys will get that information. You'll get a lot of other good information as well. It is free for you to attend. I'm paying this out of my own pocket to help everybody in 2021 because I know there's a lot of concern about the economy. A lot of people are writing me emails and writing comments on my videos asking for this type of conference. So I put it together very specially for you at my own expense. I'm not asking you guys to pay for this, to help you guys do your planning for 2021. I really have scheduled this to help you guys out. Hope that you will attend. We're going to take up to 2,500 attendees. And at that, I'm going to cap it at that point. So get your registration in as soon as you can. It starts in about 12 days. Hope to see you guys there. That's going to wrap the video for today. I'm off to do more research on more videos this week. We're going to come back to the LBMA and the COMEX later this week, and we're going to offer more clarification about that market. Stay tuned for that and many other things on our channel, goldsilverpros.com. Thanks, guys. See you next time.